Ladies and gentlemen, a good day and welcome to the Q2FY25 earnings conference call of Relaxo Footwears Limited, hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Gupta from IIFL Securities Limited. Thank you, and over to you, sir.
Thanks, Muskan. Good evening, everyone. We have with us the senior management of Relaxo Footwears today, Mr. Ramesh Kumar Dua, Chairman and MD, Mr. Gaurav Kumar Dua, Full-Time Director, Mr. Sushil Batra, CFO, Mr. Ritesh Dua, Executive VP and Finance, and Mr. Ankit Jain, Company Secretary and Compliance Officer. Without further ado, let me pass it on to Mr. Dua and team. Over to you, sir.
Thank you, Sameer. Good evening, everyone, and thank you for joining us on our Q2 and H1FY25 earnings call to discuss the financial and operational performance of the company. We have already uploaded the earnings press release and the investor presentation on the stock exchange as well as on our website, and we hope that you have had an opportunity to go through them. Before we begin the question and answer session, let me quickly go through some of the highlights on Q2 and H1FY25 performance, beginning with Q2. Revenue from operations in Q2 FY25 was at rupees 679 crore as compared to rupees 715 crore in Q2 FY24, a decline of 5% year-on-year. This is mainly due to weak market demand during the quarter. Our EBITDA for the quarter was at rupees 88 crore as compared to rupees 92 crore in the corresponding quarter in the previous year. The company maintained its EBITDA margin at 12.9% during the quarter as compared to 12.8% in Q2 FY24, despite the subdued demand. PAT was at rupees 37 crore as compared to rupees 44 crore reported in Q2 FY24. PAT margin for Q2 FY25 stood at 5.4% as compared to 6.2% in Q2 FY24. High depreciation in the quarter has impacted the profitability of the company. Now moving to our H1 FY25 performance. In H1 FY25, we recorded a revenue of rupees 1428 crore. EBITDA was at rupees 187 crore compared to rupees 199 crore in the same period of last year. EBITDA margin was at 13.1% as compared to 13.7% in H1 FY24. PAT for H1 FY25 stood at rupees 81 crore against rupees 101 crore in H1 FY24. PAT margin was at 5.7% as compared to 6.9% in H1 FY24. The company has incurred a capex of rupees 49 crore till 30th September 24. Our company continued to be net debt-free and is supported by positive cash flow from operations. Our company is in process of adding new distributor and focusing on to improve retail network through various initiatives. Further, in line with our continued focus on cost efficiencies, we are working on optimizing our back-end operations, which would enable us to deliver a sustainable performance in future. Thank you. The floor is now open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Videsha Seth from Ambit Capital. Please go ahead.
Hi, thank you for the opportunity. My first question was on the commentary that you made in the press release regarding consumers downtrading to lower priced unorganized competition and your call to not dilute prices. So how do you see that impacting volumes and market share in the near term?
Hi, this is Gaurav. we are seeing there's a very poor footfall happening in across the country, what we have noticed, and there is a mushrooming of local players. The unorganized players, new unorganized players have also come into the play. So there was a pressure on us to reduce the prices, which we have not, and we are in process of adding more retailers and distributors to counter that.
So Gaurav, where I'm coming from is that during FY23 also, when we faced a lot of pressure from RM inflation, we chose to increase prices, but we also then lost market share due to that. So do you see this call of not diluting or reducing prices impacting volumes as well, or impacting our market share in the near term?
Temporary, we can say yes, but in long term, I think we will be able to gain back the market share. Because of there is a two factor. There is a poor footfalls, demand is also subdued, and the raw material prices, all these things, multiple factors, they were able to enter them. But I think now the wedding season, we are hearing Q3, a lot of weddings are happening. There will be a demand uptake in the market, and things will improve.
Got it. And the second question was if you can share your observation on the channel inventory and some granular sense on consumption trends as well. While there is overall weakness, but if you could break it down into how have you seen trends move in rural versus urban, and also the competitive landscape.
Channel inventory we are maintaining. There is an increase in the inventory as compared to, I think, March. So it has increased due to subdued demand. And inventory we are carrying almost in GT and new channel is the same level, but retail it has increased little bit. So overall there is an increase on inventory front.
Got it. And my last question is, what would be your outlook for margins versus the earlier guidance of 15 to 16% for FY25?
I think company is taking a lot of steps to improve the margins. They have been on backhand front. We are working very closely with the manufacturing how to really improve our productivity and add on to our margins.
Thank you for answering my questions. I'll get back in the queue.
Thank you. The next question is from the line of Shirish Pardesi from Centrum Broking. Please go ahead.
Hi, sir. Good evening. Thanks for the opportunity. On the slide in the beginning, I observed that our average realization per pair has gone up by about 6% to 156 rupees, and the number of pairs sold is lower. So I do understand there is a demand issue and other thing, but is there any regional variation because we have larger business coming from north? Is the difference between north and south and west and east is different in terms of this demand situation?
See, across India, we are seeing this issue, of demand not being optimum. But east, like if you say talk about east, is most affected. So payments are very slow coming from eastern markets. So east is the market which has been mostly affected. Yeah.
Okay. So we have been saying that we are trying to, in fact, improve the mix towards the premium end also. Any color, any mix you would be able to highlight at this point of time?
The status quo. Yeah. Last year, our price is more because we revised the prices in January. That is the effect of higher ASP.
Okay. And in terms of Sparks contribution, would you specify how we should look at in second half? Because you said that you are focusing on the distribution angle also.
Sparks, I think we are able to maintain the momentum in Sparks compared to the other open footwear. So I think Sparks should definitely be better off compared to other two brands, that is Flight and Bahamas.
Okay. So assume that first half the situation, demand, down trading, regional competition, local competition, if the status quo is there, how we should be looking at second half? Because even second half was, the base is benign at this point of time. But does last 30-40 days give you some confidence that we will be able to recoup our volume growth?
Currently, in October or whatever, you can see the start, we have not seen the great start. So we are hoping that, because of this November, December having huge number of weddings, so demand should improve.
Okay. Thank you and all the best.
Thank you. The next question is from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Thank you for the opportunity. Just wanted to check on closed footwear performance now that we've added capacities in last year. So has the mix change taken place in the first half and second quarter?
So it's same like what it was the last year and last quarter. There's not much of change happening there.
So what is the strategy to improve our mix from towards more of closed footwear?
Strategy, we talked about, again, it is like appointment of distributor, adding more channels. For example, e-commerce, we were little slow this time because of too much of ask from Flipkart and Amazon. So we are very cautious, and then we are taking steps to improve our, reach in Sparks.
So what could be the revenue growth that you are targeting for FY25-26, given that you are conservative, demand is also weak, and you're expecting improvement in demand coming forward in the quarters to come? So how should we see the growth coming in for you?
So we are really cautious of the market, and what we see is we have to grow. Like, we are appointing more distributors across territories, and we are hoping that we can grow around 8 to 10% in Sparks category.
Okay, and overall revenue growth that you're targeting?
Quite difficult to say as of now, but definitely should be positive.
Okay, and what would be the distributor and retail reach increase for you in the next 2 years for both open footwear and closed footwear?
So it's a continuous process, we keep on adding distributors, and some distributors are always so it is a continuous process. So adding retailers, like if you see 2 years back, we were at 55,000, now we are at 70,000 retailers. So it's a continuous activities, continuous process.
So we can assume the same run rate to continue?
Yeah, definitely.
Okay, understood. Thank you, and I'll come back to the question queue. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Pranshul Mittal from Mittal Enterprises. Please go ahead.
Yes, hi. Thanks for giving the opportunity. I wanted to ask a question that in the investor presentation, you have mentioned that in channel-wise revenue mix, the modern trade is about 10%. But recently we have seen
campus का.
Can you repeat the question?
हाँ ठीक है सर. इसमें ज़्यादा टाइम मत वेस्ट कर. पहले कैंपस का वाले कैंपस का कॉल है ना, जो क्वेश्चन पूछना रहेगा उसमें इसलिए.
I think this is Relaxo meet, not campus meet.
Sorry to interrupt, sir. The participant left the queue. We'll move to the next.
Okay.
The next question is from the line of Sameer Gupta from IIFL Securities. Please go ahead.
Hi, sir. Thanks for taking my question. I noticed that there is an ASP increase of 6%. I heard that you mentioned that you've taken a revision of price in January, but even from last quarter onwards, this is an increase of around 3%. So just wanted to understand, is there a change in mix that is impacting this, and some more color on this?
See, we have introduced premium categories in some of our brands, and because of that, there is an effect of increase in ASP. Plus, we have taken a price increase in the January and Hawaii category. So, and last year the base level was also a little lower.
Okay, but there is no price increase as such taken in this quarter.
No, we have not taken price.
Got it, sir. Sir, second question on this competitive intensity increasing. Now, what is the trigger for this? Has there been a sharp fall in raw material prices that has resulted in this intensity going up? And how is the company going to counter it? I mean, let's say it continues for a few more quarters. So do you have a strategy in place to counter it at some point, or do you keep waiting because it's unsustainable and it will go away at some point in time?
So we have, you're absolutely right. Because of lower raw material prices, a lot of new competitors have come in. We are working with our marketing team to devise a new portfolio, new portfolio strategy. So how to counter them. So we are working on cost optimization plus adding new products and to understand the regional needs. So we are really in touch with the market, what is happening.
And is there a role of the BIS compliance also in this, that the smaller players don't have to comply as of now? Is that also impacting?
Yeah, that is also could be a reason, because all small manufacturers, they are exempt from quality control standards. So whatever quality they want to produce, they can downgrade and they can cause unethical competition also otherwise. So that also has some role.
Got it, sir. Lastly, sir, if I may squeeze in, the other expenses have seen a decline of 3%. Just wanted to understand the broad constituents which is resulting in this. And also, let's say the volume growth comes back. Do you see this growth in other expenses also coming back, or this 220 crore number odd is the ballpark which is here to stay?
Other expenses, we took a very calculative call. We have just reduced the advertisement expenses in this period as compared to last year. So that is the major item which has come down.
But do you see this going up going forward if demand comes back?
Yes, next year definitely, not this year. Next year definitely we will review and may go back to the original percentage spent.
So FY25, what is the number that you're targeting for ad spend full year?
Generally, we used to spend around 4%. So this year, we have just thought about 3%, 1% lower than last year.
Got it, sir. I'll come back in the queue for any follow-ups. Thanks, sir.
Thank you. The next question is from the line of Gaurav Jogani from GM Financial. Please go ahead.
Apologies for the earlier, sir. And my question is with regards to the impact of BIS. I mean, while in the shorter term, because the smaller players are given a relaxation of not complying with the norms. But on a longer term, how do you see the norms impacting the industry on an overall basis and Relaxo specifically?
Government has actually given exemption to the small industry for the time being. It doesn't mean that they are going to go always. So that we have to wait and see how they see. But as far as we are concerned, we are strictly following quality control standard prescribed by Bureau of this Indian standards, and that's it.
Yeah. So because you guys are following the quality standards prescribed by the agency, then can you be marketing your products as a better quality product, and hence it is ISI or BSI mark. So can there be a marketing angle that benefit guys at the value end who are following these norms? Is there a case for that?
On the long term, this will benefit the company. In the short term, because of there is a market downtrading, people are not having enough money in their hands, so they are going for cheaper products. But ultimately, cheaper product can never create a future. Future is always for the quality products that we are following.
Sure, sir. Thank you, sir. That's okay.
Thank you. The next question is from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Hello. Wanted to understand the capex for the year. What will be the full capex for FY25 and 26?
FY25 already we have spent around 50 CR. So it will be again in the range of 50 to 60 in next half. So total will be 100 plus in this full year.
And what is it going to be spent on? 100 crores?
This majorly we have spent upon I think mold is a regular item which we spent around 25 to 30 CR. Then we are adding some machineries and some civil work also. It's a mix of all these.
Okay. Can we assume any capacity addition in this?
No.
Okay. Thank you, sir. Thank you and all the best.
Thank you. The next question is from the line of Aniket Kedia from Phillip Capital. Please go ahead.
Sir, when you say October has been a slow month for you and you're hopeful for November, already primary sales for November would have been done now, and you would be generating demand, for the next month. So are we seeing pressures in primary demand from distributors and they're sitting on high stock? And if you can answer separately for open footwear and closed footwear.
So it is same for both open and closed footwear. Still, the demand has not, we are hoping that next 2 months should be better compared to what has happened last quarter. So because of poor footfall, these things are happening. So it would be gradual. It cannot be just immediate. The things will change.
And sir, are we facing pressure from organized players as well, like Walkershaw and Aqualife, who have also become aggressive in the open footwear category, or it's more from the unorganized only what you called out?
They are also facing challenge from unorganized. I think they are also facing a lot of issues compared to BIS of unorganized play. Lower footfalls. It's for full industry. It is same.
And sir, 3 quarters back, last year when we had lost market share, you alluded that you would go for market share gains and not for margins. And now again, as a strategy, you're going for margins and not for market share gains. So, what is the long-term thought process of the company on top-line growth versus margin?
So we are taking a balanced approach. It cannot be one way. It cannot be only margin or only sales. We have to take a long-term view and take a balanced approach.
Sure, but with a steady decline in volumes, consumer is downtrading, and that is impacting the brand as well.
No, on the long term, we have to see the things. Our strategy has to be not based on what currently we are going through. We have to make quality product, and we have to sustain the things. We are adding distributors, we are adding retailers, we have introduced retail app. Our connect with the retailer is improving, and this is a base is improving of our retailers. Our reach improves. Definitely, the sale will also improve.
Sir, can you separately call out the growth in the north market versus the west and south, if possible?
Please.
Can you separately call out the revenue growth or the volume decline in north versus ex of north region?
Just a second. There has been just marginal, 1% drop in some areas, sustained in the west and south. So basically, east we have seen a little more dip compared to other regions.
Sure. Thank you so much.
Thank you. The next question is from the line of Aditya Khetan from SITS Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. My first question is onto the volumes part. Sir, in H1, we had seen that the volumes have declined by almost around 5% as compared to the last year of H1. And sir, you have also stated that the muted demand and all, and you are hopeful for a good wedding season. Sir, so any guidance onto the full year volume side, if you can share, so whether we can see a positive growth or it would be flattish?
It would be flattish because it will take time to cover up, the 6 month sales and volume loss.
Okay. And sir, despite facing this muted demand, sir, so when we look at the operational metrics like your gross profit per pair and EBITDA per pair, so that has gone up on sequential basis by around 3 to 4%. I wanted to know, is there any component of the better product mix which we have seen in this quarter?
EBITDA is by and large same in the first quarter, second quarter. If you compare to last year's first quarter and second quarter, total H1, H2, it's just a 0.5% difference of EBITDA.
Got it. Onto the gross profit, sir, we have seen a good improvement. Any comments over there?
The gross, definitely there are two reasons for this. We took a price increase in January, so that is the advantage has come in the system. Raw material were also, I think, eased out. And third is if you see the percentage, there is an increase of inventory, so that the percentage is, I think, 1% looks better than the last year. So these are the three reasons. So one is the price increase, second raw material advantage, third that is the accounting part. You can see there is an increase of inventory around 47 crore in this. That includes a conversion cost also. That's why that margin looks better.
Got it. Thank you, sir. Thank you. That's it.
Thank you. The next question is from the line of Jasmine from VT Capital. Please go ahead.
Hi team. I wanted to understand your comment on reduction of the A&P cost. My understanding is that the demand is muted, the local players are kicking in. So what is the rationale of reducing our A&P spend when this time I believe there should be more spends to garner more market share and hence increase the volume and sales?
So what we have done is we have reduced in advertisement but increased on schemes, and sales and promotion. So because of trade push is required for an immediate scenario, so we have increased our schemes expenditure.
Great, that answered my question. Thank you so much.
Yeah.
Sorry, I didn't get that.
No, yeah, you got the answer, I think. We have adjusted with the schemes. Yeah.
Okay, great. Thank you so much. All the best.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Sachdev from Trivedi Capital. Please go ahead.
Hi, can you hear me?
Yes.
Yeah.
Hello? Okay, great. Ramesh, thank you for taking my question. Hi, Gaurav. This is Sachi Trivedi from Trident Capital Investments. My question is slightly more longer term oriented. Now, in the last 2-3 years, we have seen two things happening. One is the shift of demand from open to closed footwear. And the second is the shift of demand from probably, the physical channels to online channels. How did you not see this coming?
There were multiple factors, like for example, nobody saw that there would be such poor footfalls leading to poor payments from the retailers. So it's very difficult to really gauge, how the monsoon will come up, how election will, what will the result of that. And plus, the lot of unorganized players coming up because of BIS issue. Like we never thought that government will give them, leeway, you can come enroll after a year. So many things you cannot predict. How the things will operate, how government will come with the new policies.
Those are like monsoon and election and BIS, I think is a very, I don't think that is frankly the crux of this. We are talking about a very structural, a very secular shift in demand from open to closed footwear. You look around yourself, people are wearing shoes, those athleisure sports shoes. And there's a very structural shift onto online. In fact, online players are having, disruption from, being from e-commerce to quick commerce and whatnot. So there is a massive disruption happening in channel. Given how widespread you are, given how many contact points, retail points you had, I am surprised that you did not, catch on to the changes, the tectonic shifts, the structural changes that are happening in the industry.
No, as far as there is a conflict of channel, general trade versus online channel. There is also too much of discounting pressure on online channel. So strategically, we are there, but we have to be very cautious of our general trade. Our multi-brand outlet, they get suffer when they see too much of discount. This year we have to actually say no to Flipkart and Amazon because they generally give too much discount and that affects us. So we have to be very cautious in the changing scenario. Things are conflicting, they are very complex also. So we are now creating separate portfolio for e-commerce. That is the things are in total, I mean, kind of a conflicting and not complementary, but sometimes totally opposite. Whatever when we think about the general trade, that gets affected our e-commerce, and when we look for only e-commerce, then heavy discounted sale may go up. But on the long term, our general trade gets affected. So we are grappling with this issue and trying to create a separate range for e-commerce so that this conflict should get minimized.
And plus, consolidation will happen. Now, this year, maybe last 2 years, you can see in online, there are multiple new brands have come up in footwear. Like earlier it was 20 brands, now there are more than 200 brands selling footwear. So consolidation will happen. Now discount war will be controlled. Like a lot of things are happening in online. Yeah.
And our 2/3 business is open footwear, which will never go on e-commerce. Price low price, masses article. It is not profitable to work on e-commerce. All this masses article.
See, this disruption because of the online is a very, it is something to be not taken lightly because we are seeing industry after industry being disrupted and, completely changed and transformed because of this. Do you feel that this could have a and I mean, Ramesh, given your very, very rich experience over decades, do you think this is probably the biggest challenge that you are facing now? Simply because a shift in nature of demand and the channel of demand is causing and has allowed a lot many competitors, whether it is, people who are coming today and, selling maybe for one season and going away, but all of a sudden they have the shelf space that they could never get in physical retail industry. And we are seeing in cosmetics, we are seeing in beauty products, new age players are coming up. They have gained enough critical mass, and the old legacy players are really suffering in volumes. Do you think this is the kind of challenge that you are facing? And I'm curious to hear how you place this challenge, the size of this challenge to, everything you have seen in the, decades of experience that you have.
No doubt, things are challenging. We are also mindful of the situation, what is unfolding, but we have to balance between general trade and e-commerce. In e-commerce, we can't, at the cost of general trade, promote e-commerce. E-commerce, we are mindful, we have started selling as brand as seller, where we can control our pricing also. Earlier, we were selling directly to Flipkart and other distributors. There was no price control, which was affecting our general trade. So we are building our own brand as a seller and trying to sell direct to the consumer and watchful of the situation so that we can coexist in the general trade also and e-commerce also. And also, 2/3 of the articles that we manufacture, they are meant for the masses. And these masses articles, they are not viable to sell on e-commerce. We have to do that business through general trade only.
So then one final question from me. The articles the 2/3 of articles that you have for the masses, now these people are probably not going online also. Why has there been no growth in this masses category over, the last almost 3 years now?
No. After all, market with open footwear, closed footwear is there. But in the general trade, in the 2 years, the demand has been low. And now in this year, we find a lot of unorganized, low price articles have entered the market. There is a problem of money in the hand of the masses segment at the moment, what we are witnessing. That is why they are trying to go for cheaper alternatives. But on the long term, quality articles will also be the aim of the company, and that will only help the company. We can't go for the reducing the quality or do anything just for the time being.
Okay. And actually, if you don't mind, I saw that you have tied up with Disney and Marvel. Does it mean you are going to have some focus on the children's segment?
Yeah, that will help, that will help in the premiumization of our article, which are meant for children and others also. So we have done a slow beginning, but in the coming time, this will help us improve the ASP of the company.
Okay, thank you very much.
Okay.
Thank you. The next question is from the line of Devanshu Bansal from MK Global. Please go ahead.
Yes, sir. Hi. Thanks for taking my question. Sorry, I have joined the call late, so please pardon me if I'm repeating anything that has been answered before. Sir, I just wanted to check on your remarks that the industry has sort of witnessed an increase in lower priced unorganized competition. So firstly, I wanted to check what exactly is this unorganized competition. So earlier, during this entire calendar year, these imports from China, etc., were on a decline. But now, over the last couple of months, I guess the imports of such articles have seen an increase. Are you referring to this, or are you referring to all those smaller scale MSMEs that are operating from India and they have suddenly increased the competitive intensity in the space?
Yeah, it's actually both. Plus, 2 years back there was change of GST from 5 to 12. Since then, a lot of new players on unorganized competitors have come up. There are multiple reasons for that. One is the lower price raw material. As when the raw material price goes down, definitely new players come in, and the price goes up, they really vanish. Plus, we can talk about these are regional players, which have been having no brand, not paying GST, they don't have BIS compliance. So they are taking some market share, and there are a lot of import happening. Like what you have heard, what you were saying about China import, it has not reduced, but it has increased because government have allowed them till September to import product. Since after that they cannot, because then the BIS will be applicable. So multiple factors, not one or two.
Understood, sir. And secondly, I just wanted to understand from your balance sheet perspective, the inventory levels are sort of up by about 10%. So any specific reason for that?
Due to subdued demand, then we have to run the factories, and because there is a pressure upon the demand, that's why inventory has increased.
Okay. I just wanted to check because this time around this festive season has been early. Despite that, the inventory levels are up and receivables are down. So I just wanted to check. As in, is it like some demand levels in festive also sort of remaining low?
So far, demand has been subdued, even in the month of September and October. We are hopeful that November onwards things will improve.
Understood, sir. Thanks for taking my question.
Thank you. The next question is from the line of Lavita from Miraya Asset. Please go ahead.
Thank you. I have two questions. So, with respect to how we are positioned in the market, are we seeing any portfolio gaps in the open or closed footwear category? Since we have seen Crocs being successful last 2-3 years, the way customers' preferences have changed towards more comfort wear and fashion wear. So, are we looking at newer categories in any of these open and footwear space? And second question is...
Continue, please continue.
Okay, so my second question is towards marketing strategies. Are we looking at any differentiated marketing strategy? Because we see the high-end brands have a different appeal towards the young millennials and customers. So what's your take on that? Okay.
So we are in touch with the market constantly, and we are always aligning our portfolio with the market. For example, like from basic slipper, people are moving to colored and printed slippers. So we are going to launch whatever the gaps are there in the portfolio. We are in constant touch with the market and giving product accordingly. Secondly, about marketing strategy, definitely the way the world is moving, we are also moving from from offline to online advertising. So we are doing a lot of branding in the digital space now.
So so I wanted to understand more on the specific category, as in, is there a trend that is where we have not looked at? Is there something, any space in any particular category that we have not looked at and we are approaching towards it? And in terms of marketing, more towards a different message that we can, a unique way of marketing strategy, apart from being there online, which everybody else is. That's all.
So when you talk about the product gaps or portfolio gaps, like definitely marketing is shifting from sportswear to athleisure. So we are in touch with the market, be it people are going for chunky soles or different color, different design. So we keep on doing this analysis and introduce product accordingly.
No sneakers are coming.
Yeah, the sneakers, like the sneaker trend is there, the street fashion is there. So we are in line with the market trend and launching products accordingly.
Okay, understood. Thank you.
Thank you. The next question is from the line of Devanshu Bansal from MK Global. Please go ahead.
Yes, sir. Hi. Thanks for the follow-up opportunity. My question is, sir, in India, there is a lot of footwear parks that are being created in Tamil Nadu, right? Where all large Taiwan-based players are entering the space. Haryana as a state also has similar advantage from a cost of labor perspective. The footwear industry is quite well established in the state. Any thoughts around this incremental Make in India opportunity that is emerging? So your comments on that, please.
In Tamil Nadu, whatever manufacturers they are coming, they are from Taiwan. They are making for multinationals, and mostly they are making and then exporting. So that is not going to affect our domestic market in that manner so far.
I wanted to check if we can also sort of explore as in utilizing our facilities in the lean period for such demand that may be there. Any thoughts around that?
No, we have to see what is required by Indian market, Indian consumer, and what kind of the masses consumer that we have, how we have to address their needs. So we are developing our article as per the needs of our customers, and we are aligning that. There are value for money or quality, whatever affordable quality we can buy. That is what we are focusing.
Understood. And sir, there were some news reports, though it was not wide, but there were some news reports on this GST being reduced from 12% to 5%, right, for footwear. So any thoughts around that? Any representations being a leader that you have made to the government in sort of because there has been a lot of disruptions, right, because of this unorganized lower price competition that is there. Any thoughts on this, please?
The representation by the industry is being made regularly at regular interval. Currently also, industry is taking up this matter with the government authorities.
Any expectations from that perspective?
Government will never commit. These things are, you can only make representation, and then we have to wait.
Understood, sir. Thanks for taking my question.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Samir Gupta from IIFL Securities. Please go ahead.
Sir, just a follow-up. The separate portfolio for e-commerce that you have mentioned, any timeline that you can share by when do we expect to launch this? And is it going to be margin dilutive because this is being done primarily to bypass the e-commerce channels discounting nature and its effect on GT?
So we have already bifurcated the online portfolio, e-commerce portfolio. Now we have, what about, second question is about the margin dilution. So we are not going to dilute our margins in that category.
Then, sir, how does it address the issue, which is basically the online players discounting and that affecting the channel? How does it affect that issue? I mean, if we are not going to participate, then how is the separate portfolio going to help?
No. See, participation was for the Big Billion Day and the Amazon Festival, where they were offering huge discounts. Other small activities or any other days, we will be there. Our only thing is to protect the margin for protect the interest of the both channels. You know, we have to see about the brand also, at what level we can give discount. And it should be in concurrence with us, you know, how they decide the discounting policy. It cannot be wherever they want, they can give what kind of discount they can offer, like, you know. So we are more focusing on more of BAS, brand as seller, compared to giving outright sale to them. And
agreed, but when this separate portfolio, you will still be brand as a seller. You are not going to outright sell to the Flipkarts and Amazons.
In that scenario, it depends upon what will be the discounting philosophy of that brand. You know, for example, Flipkart, we will not participate when the high discountings are happening.
And how does it work? So the discount is borne by the Flipkart and Amazon, or it's kind of shared between you and?
See, on the special days like Big Billion Day or Amazon Festival, they give from their side without taking any, you know, approval from us or sitting together and deciding the price. So they just, whatever they feel like, they give discount. So we do not appreciate like these kind of discounting practice.
We have to protect our general trade also.
Yeah.
But so if the portfolio is bifurcated, it will protect, right? I mean, how I'm not able to understand this. So
No,
I understand the brand image part.
So we have to be mindful of both the things. General trade, once you make the article separate, okay, that thing is there. But still we have to be mindful of how we have to manage both the channels and what the brand image, what kind of discounting we want to allow. So we have to balance out all these things and take a very cautious move.
Got it, sir. Second question, and I heard this during the course of the call, that BIS for smaller players, you mentioned that a leeway of 1 year has been given, but my understanding was that right now there is no such deadline to comply for small and micro enterprises. Just wanted your clarification on this, sir.
This is what orally the minister declared, but how they will do it, there is no writing on it.
Got it. So officially there is no such deadline. Minister, the minister has said is what you are referring to.
That was, he said, our intention is that everybody has to comply, but for the timing, these small players are being exempted.
Got it, sir. That's all from me.
Thank you. A reminder to all participants, you may press star and 1 to ask question. A reminder to all participants, you may press star and 1 to ask question. Is there no further questions from the participants? I now hand the conference over to the management for closing comments. Over to you, sir.
So this is all from our side, and we thank you all for joining the call. Looking forward to joining you again. Thank you very much. Thank you, everyone.
Thank you. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.